Welcome to Big Money Monday on the Savvy Radio Show. Get ready, you are about to get paid. This show is designed to increase your financial intelligence every Monday.
What's up, Savvy Investors? Today is Big Money Monday. And if you haven't tuned in on Mondays before, you're in for a real treat. My goal is to increase your financial intelligence. And what does that mean? That means the more you know, the more you make. The goal is to learn how to borrow money, how to leverage money, how to use money instead of work for money for yourself. So don't trade time for dollars, trade money to make more money. All right. So that's what Big Money Monday is about. Today, we're going to go over some key basics. I'm going to rock out 3 just simple terms that I'm going to cover today, and then I'm going to answer some questions that I've received. So pretty cool, huh? So today we're going to talk about collateral, LTV, and promissory note. So if you don't know those, and you may know those, but you may not know what those are. All right, first of all, it's collateral. Widipiki says collateral is the borrower's pledge of specific property to the lender to secure repayment of the loan. All right, it's something like you at a pawn shop, you want to borrow $20, you put up a screwdriver, that's collateral. Okay, the collateral serves as a protection for the lender against a borrower's default. Now, you as a borrower, me as a borrower, we don't want to default, and we think we're not going to default, and I hope and pray that you never default, but the banker, he doesn't really give a rip. That's why he has to have collateral. And so if you don't pay your loan on time, or you default, or you get all buck wild, then he's going to go after your collateral. One of the common mistakes is that people think lenders are in the real estate business, and that's not true. They're in the financing business. Now, there's specific banks that I work with that like real estate, but bankers are not in real estate. They like real estate, the right bankers do, is because it's collateral. It's protected for them. They're in a safe business, and, more millionaires are made through real estate, but the richest people are the bankers. Now, why is that? I don't know, but it doesn't really matter. Well, it does matter. If you really want to become wealthy, you really need to study banking and understanding it and how it works and about leverage and loans and the paperwork, but that's on another episode. So let's keep on rolling. What is LTV? LTV is simply the loan amount divided by the value of the collateral or the property. For example, if the bank loans you $65,000 on a property, the ARV after appraised value was $100,000, that means it's 65% LTV. That's the loan ratio. Now, a little tidbit for you. The 65%, that's also in bankers' term called protective equity. So again, let's repeat. You got a $100,000 property. It's worth $100,000. You got an appraisal on it. And the LTV, what's the loan value that the bank's going to loan on that property? Some banks loan 70%. Some banks loan 65%. Some banks loan 100%. Hard money, maybe 60, 65. If you have a great portfolio and you're really great with your finances, and you can probably squeak out 75. Years ago, it used to be 80 or 100 or 112. That's the LTV, the loan value. Okay, loan to value. All right. The LTV is one of the most important numbers to the lender. And if you borrow enough money long enough, they're going to do it all over your whole portfolio, all off your equity. But you need to know what LTV is. All right, a little final definition today. What is a promissory note? A promissory note is a written promise to pay or repay a certain amount of money at a certain time in a certain number of installments or on demand. And it's named that person, okay? The promissory note is secured if there's some collateral or value that secures the loan. For example, say Timmy borrows $10,000 from John and offers the house as security. If Timmy fails to pay back John, then John can offer Timmy's house to get his money back. This is called a secure loan. Now, there's other types of loans, unsecured loan, but like think of your credit card. So your credit cards are unsecured loans, instruments. All right, that's why they're kind of dangerous, because if you really had to put up something to borrow something, you'd think twice about not paying your payment on time. That's why credit cards charge a much higher rate of interest, so on and so forth. All right. So did you get that? So that's our three definitions, and then we'll go into some crazy questions, all right, that will make you think. Collateral, that's something that backs up that loan. You know, if you go get a car, your car is collateral. You can get a loan against your car. All right, so you know what collateral is. LTV, what's the ratio? So if you're borrowing $100,000, you can get up to 75, 70, depending on the bank, depending on your credit worthiness and all that jazz. And you need to know what a promissory note is. All right, here's some questions that people have asked over the years, and so I'm going to try to wrap them up real fast and not keep you any more delayed. Question is, how could some banks are willing to loan money on rental properties and other banks are not? They're dumb. That's one reason. Well, anyway, they are dumb. But the point is that real estate, like in commercial money, is specific to what they're trying to do and to grow their bank. There's actual banks out there that their business model is to get deposit and make monthly fees. Another bank could be just focused on loaning money on cars or owner-occupied properties. So whatever their niche is, that's what they focus on. So if some bank turns you down and they don't understand rental property, it's not you per se, it's maybe that bank, and that's what they're doing. I remember there was a credit union that was trying to bulk up. I mean, they were like trying to go all big. And what I mean by big, that they were deficient in their commercial lending. And so they were really motivated to ramp up their commercial side. So you have like banks have a commercial side, which could be like businesses or entrepreneurs or landlords or real estate. That's kind of the commercial side. And then you have like the consumer side, which could be auto loans, owner occupied. So this particular credit union wanted to bulk up, wanted to increase their commercial side. And so they were loaning money. Actually, they were being very competitive, that they were lowering their rate down to like a half a point or even a point. So I'm thinking this bank is great. I move over a bunch of money. What I mean by moving over, not my actual money. Like I have loans. Say I have like $400,000 at one bank. I move that $400,000 over to this credit union. Now, of course, I incurred fees and appraisals and things like that. But I could have got better terms. Like instead of a 5-year balloon or a 10-year balloon, I could have got a longer year type loan. Okay. But so I use this bank. Everything's great. They're awesome. It's automated. And then a couple of years later, I'm like, man, that bank gave me 4%. I need to call that bank back. I need to shift some money around. So I call that bank, and they don't loan commercial money anymore. Like some CEO in that credit union decided not to lend out anymore on commercial side. So again, banks change. So keep that in mind. So there's a specific bank I use for real estate, but they could be a farm bank. They could be really specialized in heavy equipment. And then for a season, they may be all into apartment buildings. There's some banks that just don't loan to apartment buildings. They don't get it. They don't understand. So not all banks could service you in what you need. All right. So I mentioned the word earlier. What are balloons? Balloons are not things that you give your kids for your birthday. All right. Balloons are a specific time where it gives the bank, again, the rules are written for you, the investor, or for the banker. Well, the banker actually wrote the rules, so thus the rules are in their favor. You got to keep that in mind. Think about that. Bankers wrote the rules in their favor for bankers. Okay. So you think of like the Constitution, it was written for the people, of the people, for the people. Well, bankers' loans and rules are written for bankers to succeed. And so balloons actually kind of go in their rules. It gives them a way out. So most people, they get all crazy. They're like, yeah, I got a 30-year mortgage, right? So that, it's real safe for you as a consumer because 30 years, your interest rate. And, when our whole economy crashed, we had an ARM, and that's adjustable rate mortgage. And, everyone's up in arms. Well, what balloons are is that banks set a time frame that you have to think about what you're doing with that specific loan. So if you went to hard money, they like a balloon of 12 months. They want their money back. They don't want to be into that riskful loan for a length of time. So a bank that I deal with, they usually, most common commercial money right now is about 5 year balloons. And so a lot of rookies, they get all crazy like, oh, do I got to pay it off in 5 years? No, you just have to have a plan with what you're going to do in 5 years. Because if your interest rate, say, is 6%, and the new president comes in and world crashes and the interest rates go up to 10, and it could happen 10, 12. It's happened in the 80s. It could happen again. Well, the bank doesn't want to be, trapped in that they're loaning it to you at 6% and everyone else is paying 12%. The actual bank will lose money. That's why they have balloons. Now, keep that in mind. You want a long term, right? You want to fix it in within reason. But, there's some commercial money out there. They only do 3-year, 5-year balloons. So you just need to be prepared and understand what a balloon loan is. And on that balloon loan, I've noticed that if you say, hey, I want to do a 3-year balloon, the interest rate is cheaper. So it could be 6%, but the banker asks me, hey, do you want to do a 5-year balloon? It's going to be 6.5%. So anyway, should you use them or avoid them? They're available and they're there. And if you're a real estate investor, that's what you're going to have to deal with. Okay. I don't know if you can necessarily avoid them. Yes, if you go to FHA money, but you're going to do a lot more hula hoops. It's not going to be a lot more nimble for you. All right. Robert Allen. Okay. He's a great author, wrote the book, Creating Wealth, Nothing Down. Robert G. Allen. If you haven't read those books, definitely recommend those. Robert Allen says, buy property with nothing down. Get it? And then this is another question out there. Robert Allen says, buy property with nothing down. Dave Ramsey says, avoid debt and paid cash. Who am I supposed to listen to? Thanks for whoever sent that question in to me. Man, it's all about what you can handle, okay? I look at debt as a loaded gun, all right? So it's dangerous. You can get over-leveraged really fast and kind of lose it all. That's kind of Dave Ramsey, what happened to him. He was over-leveraged 20 years ago and lost all of his property, several $1 million, and got a whooping. And, Robert Allen says buy houses with no money down. Well, I look at it as, what is a true no money down deal? Well, you may not actually put money in, but you are bound to that money if you get a loan. Okay. So you really are putting something in. It's your character, your equity, who you are as a real estate investor. So there's really nothing, not saying that you're not putting any money down. Nothing's free. Okay. But you can do a no money down loan and flip that contract or sell it. And then you had no money in it, and eventually. So which one? Who should I listen to? Well, I think you should just, what's your risk tolerance? All right. People think that I'm real aggressive and, leveraged out several $1 million, so on and so forth. But all of my debt that I think in my mind is calculated, meaning I try to buy every property at 70%. And I think that way because if I have to sell that at a fire sale, and I can sell it for 70 and I break even. Well, I didn't really break even because I held that rental property for 3 or 4 years and I made $200 a month for 3 or 4 years. And what's my return, right? And then if I got my money back or I paid back the loan, I didn't have any money in it, but I made $200 a month. All right. So if you're an average person and you watch the news every day and you're scared and you think you're going to pee your pants all the time, that the world's going to end, then you probably should listen to Dave Ramsey. All right, that's just a quick answer. I know it's not nice and sexy, but in anything you do, there's risk. I think there's risk getting in your car and driving while I look over and there's a 12-year-old or 15-year-old, 16-year-old, not 12-year-old, but a 16-year-old gal on her phone text messaging, weaving all over the road. I think it's safer for me to go buy a property with no money down and get a return and enjoy life through those dividends than driving around worrying about someone else may hit me. So hopefully this helps you. Big Money Monday. If you got a question, if you like this episode, let me know. If I need to work on it some more, I know I'm still trying to roll out these Mondays, but it is Monday. Hopefully you do it well. Use money, bank money, grow your business, and whatever you do, buy assets for your family, build a legacy.
Investor Weekend is not far off, with over 10 information sessions to increase your portfolio. Log on to www.investorweekend.com. Whether you are a seasoned investor or never purchased a property before, you don't want to miss the Investor Weekend. Join us for a powerful, knowledge-packed weekend with over 10 informational sessions that are bound to enlarge your real estate investments. You will hear from the best national and local real estate investors that will share practical and relevant experiences with you, the investor. There will be several networking sessions to connect with other like-minded people for potential funding, partnerships, and yes, hot deals. Go to www.investorweekend.com. Did you know we meet once a month for the Landlord Lunch meeting? The third Wednesday of every month. Go to landlordlunch.com.
Thanks for listening to the Savvy Radio Show. Glide online and listen to our other motivating episodes at savvyradioshow.com. Connect on Twitter at LandlordBook and always be buying assets.